Happy New Year, everyone! Thanks for taking the time to watch our video on the Christmas gift that you probably weren't expecting this year, the Secure Act. This act is the most impactful legislation affecting retirement accounts in recent memory, and our team's been following it since about May of last year, but openly, I think it surprised us all with how quickly it was passed and signed into law. My name is Kyle Frizzell. I'm one of the attorneys with NC Planning, and we've put together this video to introduce this act to you, explain how the act impacts your estate plan, and also to give you an idea of what you should be doing in light of the Secure Act. So as you can see, we've titled this presentation 5 Things We Want You to Know About the Secure Act. So to kick things off, let's take a look at where the Secure Act came from and what it does. As I mentioned before, our team's been following the Secure Act since about May of last year, when this legislation known as the Setting Every Community Up for Retirement Enhancement Act passed the House of Representatives by a very large margin. But in case you haven't noticed, Congress has had a lot of other things going on lately, so the Secure Act didn't pick up traction again until late December, when it passed the Senate on the 19th and was signed into law on the 20th. Then, in keeping with the quick turnaround, the Secure Act went into effect as of the new year, January 1st, and it's already governing our retirement plans. So what exactly does the Secure Act do? Well, while we're still parsing through some of the finer details, we wanted to highlight a few of the notable changes that it implements. Here on this slide, we've highlighted some important changes that are brought by the Secure Act, but they're not really where we're going to focus our attention today. So just to bring them to your attention, we wanted to highlight that the Secure Act does change the required beginning date, meaning when you have to start taking money from your retirement account, from the age of 70 and a half to the age of 72. It also repeals the maximum age for contributions to traditional IRAs, and it allows parents in the year of birth or adoption of a child to take a penalty-free withdrawal of up to $5,000 to help with the expenses of a newborn. It's important that you know of these changes, but we wanted to focus our attention on a provision that we think is going to have more of an impact on your estate plan. That's the focus of our next slide, and it's the second thing that we wanted you to know about the Secure Act. How does it impact your estate plan? The Secure Act implements a new mandatory 10-year withdrawal rule. This means that if you're a non-spouse beneficiary of a retirement account, you have to withdraw the entire balance within 10 years of the account owner passing away. This is a tremendous change to the way things were before. In the past, if you were a qualified beneficiary of a retirement account, you could stretch the distributions from that account over your life expectancy. If you were a young beneficiary, the required minimum distributions would have been pretty small, and likewise, the tax burden on those distributions probably would have been small too. Now, it doesn't matter. You have to take the entire balance of the retirement account within 10 years unless you fall into a category of exceptions. These categories of exception create what is known as an eligible designated beneficiary who will not have to distribute the balance of a retirement account within 10 years. The first of these are, of course, spouses. Here, things really haven't changed and your spouse is still permitted to a life expectancy payout or a spousal rollover of the deceased spouse's account into their own. There's also an exception for beneficiaries who are not more than 10 years younger than the account owner. Like spouses, a beneficiary that is younger but relatively close in age to the decedent can use their life expectancy for payouts as well. Another major exception is for the account owner's children who haven't reached the age of majority. So if the account owner has a minor child, the child can receive RMDs based on their life expectancy, but only until they reach the age of 18 here in North Carolina. Once the child reaches the age of 18, they have to take the total balance of the account within 10 years, just like under the general rule. Finally, there's also exceptions for disabled and chronically ill individuals as they're defined by the Act. As before, these individuals are entitled to a life expectancy payout of retirement accounts, but in these cases, we want to take a close look at the beneficiary's circumstances to ensure your goals are accomplished and your beneficiaries are properly planned for. And one other note about these exceptions. Even though these beneficiaries can use their life expectancy for calculating distributions from a retirement account, there is no tacking. This means that once an eligible designated beneficiary passes away, their own beneficiaries will have to take the entire balance of whatever's left within 10 years. So what does all this mean? Well, most importantly, what we know as the stretch or inherited IRA is pretty much gone for most beneficiaries. In turn, Congress expects to produce about $15 billion in new tax revenue within the first 10 years, and very likely much more than that. But back to our main question, how does this impact your estate plan? For starters, anyone that may have intended for their retirement account to be more of a wealth transfer tool for, let's say, their children's own retirement may want to rethink that. For many of you, especially those of you without a trust, this may not change your plan so much, but it's important that you understand that your beneficiaries will be receiving larger sums of money sooner and also will be paying more in taxes because of these larger distributions. However, as you see on the slide, this act has a tremendous impact on our trust-based estate plans. If, like many of our clients, your estate plan is set up to take advantage of a retirement account stretch while keeping the lump sum balance of your account away from your children, this just became a lot harder to do. With the Secure Act, you now need to consider even more than ever whether saving on taxes or protecting your children by not giving them a large sum of money is your more important planning goal. Ultimately, this is a great time to reassess your goals whether you have a trust or not, but for those of you who have trust, let's take a closer look at what this means for you. To deal with retirement assets, most trusts are either going to contain conduit or accumulation provisions that explain how we handle distributions from those assets. Under the old law, a conduit provision required that distributions from a retirement account be paid to the beneficiary to minimize on any tax burden, but it also ensured that the beneficiary received the smallest possible distribution over the course of that beneficiary's lifetime. This was designed to prevent the beneficiary from liquidating the account immediately. On the other hand, an accumulation provision takes this a step further. Like a conduit provision, it ensures that the smallest possible distribution is taken from the retirement account, but it also offers the trustee the ability to accumulate those distributions within the trust without distributing them to the beneficiary. If the distributions were accumulated, the trust pays the tax. All of this means, first, that a conduit trust has lost a lot of its strength. Because it requires distributions from retirement accounts to pass directly to the beneficiary, and the law now says that everything has to be distributed within 10 years, this style of trust may not put you at any better position than simply leaving the account to the beneficiary outside a trust. When it comes to accumulation trust, it's important to know that trusts pay taxes at a much higher rate than individuals. In 2020, trust reached the highest tax bracket when income inside the trust reaches $12,950. Because the Secure Act will require the 10-year withdrawal, if a trustee under an accumulation trust elects to withhold income, the tax burden for the trust could be tremendous. That's why it's more important than ever before to revisit what your planning goals are. So what should you do now? Well, if you get nothing else from this video, please understand that if you have a retirement account, it's critically important to review your current estate plan. If we put your plan together, we may have addressed the distribution of your retirement accounts in your revocable living trust, or we may have created a standalone retirement trust that would handle your retirement accounts at your death. In either case, if your trust uses a conduit provision, you're going to want to consider amending or updating it to prevent your beneficiary from getting the entire balance within 10 years of your passing. On the other hand, if your trust uses an accumulation provision, we're going to want to discuss whether this is still appropriate in light of the increased tax burden that may be placed on the trust itself. On this next slide, we've laid out some options about where we can go from here. These options include setting up a standalone retirement trust for those of you who want to keep your retirement accounts separate from the other assets in your estate. Or it could involve setting up an irrevocable life insurance trust to generate some extra cash to help offset the accelerated income tax liability. Also, for those of you who might be charitably inclined, we could look into setting up a charitable remainder trust, which is going to give a stream of income to your beneficiaries. The remainder of the account would go to charity, and it also helps to minimize the income tax burden. Overall, though, where your plan goes from here really depends on your personal goals and motivations. No matter what, right now is a great time to review your beneficiary designations to make sure you know where your retirement assets are going. If your retirement account names a trust as a beneficiary, you'll also want to sit down with your attorney to review how the trust will handle those assets. And this takes us to the fifth thing we want you to know about this act. We're here to help. We tell our clients all the time that if a change in the law is going to impact you, we'll let you know. The Secure Act is a prime example of legislation that could, and neglecting to at least review your plan could cause unintended distributions or tax issues for your beneficiaries. So what next? If you're an ongoing client of ours, a review of your plan is available at any time, and we're working out some dates to review your plan with you and answer any questions you might have. For those of you who may have rolled off of our continuing annual services, we hope that you'll feel free to reach out to have your plan reviewed as well. And for any of you still watching, we just want to say thank you for taking the time to watch this introduction to the Secure Act. We hope it helps you understand how this law may impact your plan and how important it is to know how your plan functions and flows. Although he may not have been referring to the Secure Act, we think President Dwight Eisenhower said it best. Plans are nothing, planning is everything. Have a great start to the new year, everyone.